Uh-oh.
Uh-oh, Josh isn't paying attention. So welcome back, guys, to another episode of the Educated Homebuyer Live. This is where we answer your questions. We talk about the economy, talk about what's happened over the past week to help you guys become educated homebuyers. So if you're new to us here on YouTube, this is this is where we do it, if you will. There's also a podcast out there, another page on YouTube where you can find videos on the educated home buyer, a little bit different than you'll find on this channel. And there's also Spotify and Apple and all of that good stuff. So depending on where you're listening, there are other platforms to reach us. But my phone is going off, Josh, and I'm trying to silence it here. But this past week, what do we get? This past week, we had some slowing economic data last week, right? So we had jobs numbers, which came in a little bit stronger than had been expected. With that, we saw unemployment actually go up to 3.8% from 3.5. But we also saw a jump in the participation rate. So more and more people out there looking for jobs, therefore a rise in unemployment. Looking again, if you just read the headlines, some of the stuff can be misleading. With that, Josh, jobless claims were down a little bit. PCE came in more or less as expected. Today was kind of a mover in the market. So last week with that data, we saw a little bit of a retracement in the 10-year. Mortgage rates pulled back a little bit. And then today we had ISM data coming in stronger than expected, with sales numbers, I think, higher than expected, or I forget exactly what
Every
it was.
subcomponent of the report was hotter than expected. Not hot, like if you look at it, not hot, but hotter than expected.
Yep.
And specifically, what are the things we talk about? All of my charts we're going to be showing you. Rent, a big component of inflation, coming down. Oil is not up, not down, kind of in the middle. Most of the things. Do you not know how to use that phone?
Dude, people obviously want to get in touch with me at 5 o'clock. They know I'm on here, and so they do this.
So in looking at that, the piece that has been worrisome to the Fed has been the potential for wage inflation. And where are we seeing that? Our economy in terms of jobs is very service focused, not manufacturing. So the news that we got is the ISM non-manufacturing survey today. So essentially the ISM services, and it was hotter than what they wanted to see. The market didn't like it. Yesterday, we had a lot of corporate issuance, fancy word for saying that major corporations out issuing a lot of bonds to finance themselves. So just additional supply. Last month, we had additional treasury supply. So we're in an uncertain time. I have in here, Jeb will show the chart, but really just showing that in the 5 days since we've been here talking to you guys, we went from nice improvement, nice bounce off the worst levels since last November to essentially right back where we were, worst levels since November. So we will see if that holds, if we get worse still, or if and when we get that breakthrough to improvement, that it's coming. So the question we need to ask, is it coming in a month? Is it coming in 6 months? Is it coming in 18 months?
Yeah. So when are we actually going to see the numbers reflected in the data, where it's no longer lagging? And so if I'm looking off the screen at the moment, guys, it's because I forgot to put the actual inventory numbers on the screen that we're going to look at here in just a minute. So I wanted to grab those, but so I do the title of these videos, right? And so a lot of times people say, you didn't address the title of the video. So I'm going to be very clear. We're going to start doing that going forward, just to, make, clear up any confusion, if you will. So the title today is Bad News: House Prices Are Headed Higher. So that's coming from an article written on Yahoo, essentially coming from a prediction done by Zillow. Zillow is predicting, if you guys haven't seen it, 10% increase year over year in home prices from, I believe, July of this year to July of next year. Now, I'll be the first to say, I don't necessarily agree with Zillow on their prediction. But like I told somebody in the comments that had commented on another video where I had mentioned this article, it's good to read everything. It's good to read the things you agree with. It's good to read the things that you don't agree with and take from each of those what you want to take from them. So could Zillow be right? Absolutely, they could. Could they be wrong? Absolutely. I more think it's probably somewhere in that 3 to 5% range with regards to appreciation year over year next July. A lot of it depends on what happens to inventory, what happens to interest rates, the things that we've been talking about. Interest rates continue to go higher, 8%, 8.5%. That could put more pressure on home prices. If interest rates pull back down, which is essentially what they're predicting, lower rates leads to more buyer demand, More buyer demand leads to a more competitive market, in theory, driving up prices because of low inventory. And then that's where you're getting that appreciation from. So if you want the article, there's a link in the description. So if you're watching this on YouTube, it's there. If you're listening on audio, you can go there, and you can also find the slides that we're going to touch on tonight. So Josh, I'm going to bring those up. Yep, go ahead.
Here's the thing that's very interesting with that Zillow data. Whenever we mention it, or whether it shows up in the video, we get a lot of comments that, oh, they're cooking the books. They want to sell houses. They want to sell ads. They want realtors to succeed. I honestly, I don't look generally and try and find nefarious reasons why something happens. I think it's high frequency data, and they're looking at 90 days and then trying to draw out what's going to happen in the next 12, 24, 36 months. So again, they have great data. They have as good a data as anyone. Big company with a lot of money. They have some of the best data scientists. I don't think they're really trying to push a narrative. I think they focus too much on the short term and try to extrapolate long term. Mm-hmm. And that's why you see these big whipsaws in what they're saying. Like they were predicting a 3 to 4% downturn by last Christmas. And now we're saying we're going to go up 10% in the next year. Yeah. If you go back to what we've been saying, that we don't have a formula for double-digit increases in most markets because we don't have enough buyers. Prices are being buoyed by the fact that we don't have enough sellers, enough homes available for those people, but affordability is at a really low level. We do not have a lot of buyers. You need to have a good surplus of buyers above and beyond the available demand to see 10% year over year.
Agreed. So with that, we're going to take a look at some charts here. And with that, we're going to start, as we always do, with inventory. Because what drives markets? Supply and demand. And supply is still treading at low levels, right? So we had an increase of about 5,000 homes week over week nationwide, sitting at 508,813. So we're still below those 2022 numbers. But what you're going to see here in a moment is last year, about this time, we started to see a decrease in inventory. This year, we're still seeing increasing inventory. Now, inventory increased in the latter part of 2022 again because of rising rates towards the end of last year. This year, we still have the rise, so it's going to be interesting to see when it tails off. This is about the time you would normally see it tail off, as you can see from this chart below, but we're going to take a look at it here in just a minute. But Orange County real estate, as we always do, 2,344 homes. So less than last week. Huntington Beach up to 200, a little bit more than last week, but more or less trending, within a couple of digits of each other. So no real change in the market there. This is our new listing. So what did we see last week? An uptick in new listings. Interesting. The data next week is going to have a holiday day in it, right? Because of this past Monday, Labor Day. So next week, data is probably going to show smaller numbers, right? And you have to factor that in, but we'll talk about it next Wednesday as we look at those numbers. So we did see an increase in new listings, which is, again, why we saw that increase. If you look at inventory, still below the trend line going back, previous 2015 or so. And, the black dot on each one of those is this time of the year in that chart. So you can kind of see, this is about the time when things start to turn with regards to inventory. As I mentioned a moment ago, we went from 503 to 508. Last week, this time, last year went from 554 to 552. So last year we saw a 2,000 or so decrease in inventory, 2,500, 2,200. This year we saw a 5,000 increase. A little bit of a change, but nothing to be concerned with at the moment. And we always kind of go back to that 2015 number. We were at 1.2 million homes. This shows new contracts versus pending contracts. 64,000 new sales pending this week, which is 7% fewer than last year, same time. Again, we got rising rates this year. Last year rates were rising during this time, but they were less than they are at the moment, which, we thought November was essentially going to be the peak in rates, and we've more or less, pushed it to a new peak, which is now being called the peak. So, Josh, we'll see if that's actually the peak. But where we are, a median home price this year, we're sitting at 448. Last year, this time we were at 440. We have a median price of single family homes in contract, so pending sales. So this year, right now, we're at 370. And we look to be easing down a little bit. Why? Affordability, rates are high, less demand out there in the market. Those numbers are going to be skewed by less transactions happening, quite frankly, and more of those transactions are going to be happening at the lower end of the price scale because of affordability, with rates being where they are.
Well, Jeb, it's affordability, but it's also demand is highest at those levels because that's where most people are entering onto the property ladder. So if you're 33 years old and you and your husband just had your first kid and you're in a 1-bedroom apartment, you want to move to a house. So that demand, that sort of life cycle driven demand is always there. Whereas people further up that chain can go, you know what? I'm going to wait this out. I already own a home. It's not ideal. I need something bigger, better, different in a different location, but I can wait it out.
There you go. Let's see. Next chart shows price reductions. So sitting at 36.2% of the homes on the market have some sort of price cut. Is that surprising? Not really. It's that time of the year. Again, less transactions happening. Rates are higher. People are having to do it. Nothing really out of the ordinary. When you go back and you're looking at 2018, 2019 on this chart, even 2022, we're below 2022 numbers this time last year. It's kind of seasonal. 21 and 2020, abnormal years. You can see those at the bottom. Those kind of trended flat this time through the end of the year, which again isn't normal, but that was a different market and hard to use those as a reference point, but they're good to pay attention to. And then Josh, inventory shifts. So this shows, where inventory was in 2019 versus where it is now. The dark red is essentially down 40% or more in inventory. And then you can see the light blue towards the dark blue is more of an increase in inventory. You got a few spots in Texas. I think Lubbock was one. I forget the exact cities there, but Texas has seen a couple. You've got a couple in eastern Idaho area, kind of through the Midwest. But for the majority of the U.S., inventory remains a critical piece of the puzzle. And that's where we get into Econ 101, guys.
Yeah, I thought we would bore you guys with the supply demand curve here. So we talk about this every week. Supply and demand, when they're imbalanced, you see that normal curve right down the middle, normal supply. Now, what happens when we have restricted supply? You see on the x-axis there that price is going to go up. If the quantity of something goes up, we push out normal demand out to boosted demand. So the little red circle there shows us what happened post-COVID. Well, we had restricted supply because of supply chain issues. We had boosted demand because people were trapped at home getting not handouts from the government, but there were checks coming from the government stimulus, and they had excess savings because they were trapped at home and couldn't spend, couldn't go on vacations, couldn't go to restaurants. So very, very predictable result in terms of increased prices as we see supply chains normalizing and we see demand normalizing. You're going to see prices come back down to where that black circle is. So I thought that was a simple and easy little chart from Econ 101 there. The next one here, just want to show here, money supply. So everyone freaked out about the massive increase in money supply due to stimulus during COVID. And now what are we seeing? It's coming way, way, way out. Now, we showed the chart a few weeks ago. We're still well above trend of where we would expect money supply to be. So until it comes down further, we don't even get back to normal. But that money supply coming out of the market will impact the economy. And you're seeing that in terms of CPI, the red line. It's been coming down. Is it higher than we want it to be? Yes, but it will continue to come down, and it will continue to come down more aggressively as money supply decreases. This one here, I kind of wanted to show, and I am not an expert on oil, but Jeb thought this was interesting. It shows a pretty tight relationship between oil prices and inflation. So that either tells us that oil prices follow with the general rate of inflation, or oil is such an important component to everything else that inflation follows it. So I would love to do some more research on this and see, if it's leading or following overall inflation. But I thought it was interesting regardless. This one's interesting here. The black line is the 10-year Treasury yield. So just since last week, we thought we had seen a peak, and we're going to continue to inch lower throughout the rest of the year. We're looking at inflation expectations on the blue and orange. Those continue to come down. Every time we do a survey of consumers and say, do you expect rates or inflation to come down? Yep, I do. And yet the 10-year is still going up. That doesn't make sense. Either consumers are wrong and they're going to come to that realization and you'll see those turn back up, or more likely we will see the 10-year trend down here. So this one, really, really important. Fed estimates of the natural economic growth rate. I think you can all see this. This goes back to 1961 when we had about 5% GDP growth annualized. And we are down here, and we're down to about 1% now. So what this shows, here, I'm going to put it in this guy's words because he's smarter than I am. It says currently 10-year notes yield 3% more than the long-term trend economic growth rate and trend inflation. So we are about 1% on long-term trend growth rate, and you could get over 4% on a 10-year treasury. So earning 4% or more in a 1% economy is the best yield premium bond investors have been paid in well over 20 years. The real question bondholders need to ask themselves is, are the 60-year economic trends in the graph reversing higher? If yes, rethink bonds. If not, get them while they are cheap. I am in the camp that this trend is not going to change. We are going to continue to see growth decreasing, and that will bring yields down over time. So yields in treasuries, eventually yields in mortgages.
Well, let's talk about that for a sec, Josh. So economic growth, why does it slow? Aging population. What are the other things that we're talking about here?
Excessive government debt. The government does not have money to put into productive purposes, and the money that they do have, when they do stimulate, I think we've shown the chart here multiple times. It used to be it took $1 or like $3 or $4 of government spending to get $1 of GDP growth. Now it's like $5.5, $6 of government spending. So what they do spend yields less growth, and there's less of it to spend because more of it is going to Social Security, interest on the government debt, all of these things that are pretty much non-discretionary, military spending, entitlements, and interest expense.
Got it. So a less productive economy means a slower economy, which means less growth, which essentially goes in line with what Josh is saying here.
And Jeb, I think it's a really important note to make for everyone watching at home. We all like lower interest rates. Low interest rates are great, but at this point, they're kind of like crack. We're all saying, hey, we'd love to get those lower interest rates back, but they are the result of bad things. It would be much better for the US to have 3% long-term growth trends and 6% long-term treasury rates. So you have a 7% mortgage rate, and this would just be normal. And you would all be happy with that if we had 3% growth in the economy, because good things would be happening, and that would be normal. If we don't have that growth, we don't want normal. We want cheap interest rates so you can afford things. We've talked about this before, Jeb. This is the latest and greatest data from our guy over at Calculated Risk. This is apartment list is the blue, Zillow, our favorite data scientists are orange, and then Case Shiller, all separate measures of shelter costs or rent costs, not ownership, and they're all trending down. So we talked at the top of the show, we had the ISM services report showing that services inflation is still higher than the government wants. Other than services inflation, this is the other element that's been trending too high, and it continues to decrease. Apartment rents are actually down in most of these measures year over year. Single family homes are still solidly positive, although way, way down from where they were. This one is also an important one to watch. Hours worked, output, and labor productivity for non-farm businesses. When we talk about non-farm payrolls, how can businesses pay people more and not have that stimulate inflation or have them have to charge more for their goods when they have to pay their employees more? Simple answer, they get more output. And going back to 2000, we see these trends, that darker blue line, labor productivity, up, 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 output, up, 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 without having to work more hours. So workers have become more productive, largely because of having better tools and technology to do their jobs with. But starting about 2022, we've seen this trend down. That would be a problem for inflation going forward. It's not meaning, hey, 9% inflation numbers again, but it will keep it higher if that were a long-term trend.
Yeah, good stuff.
This one here, Jeb, is U.S. personal savings as a percentage of disposable personal income. So remember here, we've talked about this repeatedly, that excess money available to create excess demand for goods is these big blue spikes here when people were receiving stimulus checks, being trapped at home. If they're able to work from home, work remotely, they're making good money with nowhere to spend it. So now we've seen we are back below pre-COVID trends and back to where we were 2005, 2006, 2007. So it's something interesting. We're going to see here on the next chart. This shows delinquencies by type of debt. You guys have all seen, we show up here every week and show you mortgage delinquencies are not an issue. Historically, those are the last things that people will let go. Much easier to miss a credit card payment than to miss your mortgage payment. So we've got consumer loans at the highest levels we've seen, since 2012 or so. Credit cards, same. Auto loans, the same. And all of them trending up a couple of % there. So it bears noting. We also have some additional data here. If we look at household debt, we just saw savings was down. People are missing payments, but this is household debt service payments as a percent of disposable personal income. Well, we had dipped really, really low, and they're still down here at the lowest levels we've seen going back to the 80s, telling us that debt is under control. But what this doesn't take into account, this takes into account all wage earners. So higher wage earners are less likely to have debt, and the more wages they have, more disposable income they have, it makes this number look more manageable. So all of these things have to be taken with a grain of salt and looked at in a bigger context. This is the chart we wanted to show you guys. That red line there going all the way back, the green bar, green candle at the left side shows where we peaked last November. We hit that and went actually above it a little bit about 10 days ago, 14 days ago, saw some nice improvement, and now we're right back here. We need that ceiling to hold to say that is sort of a longer term cap for mortgage rates. I expect it to, but we certainly cannot guarantee it. In terms of this chart here, key levels, 10-year yield, our little chart shows ceiling at 434. That is not literally a ceiling. It is what we believe to be the ceiling. Last week, we had got down closer to the green bars, almost all the way down to 409. So we're about 0.25% higher this week. And if you look at this 30-year fixed, according to Mortgage News Daily, the best high frequency data, 733. I think most of the data we were seeing last week was like 7.19, 7.2. These are fairly accurate. You can probably do a little bit better than this on FHA and VA, but those are pretty accurate numbers of what you're going to be looking at out there in the market.
No, and again, it's you do the best you can with what you have, right? So all the stuff is unpredictable in many ways, but again, we're here to provide with some information, and try to give it to you in a way that's digestible and where you can use it in making the best decision for yourself. So with that said, if you find any value in the show at all, do us a favor, hit the thumbs up here. You might be watching us on the Educated Homebuyer podcast channel as well. It's streaming to both. So, if you haven't checked out that channel, do us a favor and go over there and listen to it. This last week, Josh, we talked about, what did we talk about? I have no idea. Homes being, what did we talk about this week?
Hold on, my friend. I have it right here. Does home ownership really build wealth?
There we go. Wow. We talk so much about everything that I forget what we talk about. So talk about the idea of homeownership building wealth. Again, I think I pitched it last week. Minority Mindset, great YouTube channel, talks a lot about finance. Really smart dude. Agree with a lot of his principles and not really principles, a lot of what he has to say. And there were some disagreements in some of the things he said in a way that was not necessarily untrue. We just had a different take on it. So if you haven't done so, go check out that podcast. It's on Spotify, on Apple. And if you find any value in that stuff, you can you can subscribe, you can rate us and review us on the podcast channel. That really helps push it out. And with that, Josh, I don't know if you even know this, but we have an Instagram page for the Educated Homebuyer. Just started today.
I knew we had it. Does it have content?
It has one video. It will be posted on regularly starting now. We have people in place to take care of that. So if you're an Instagram user, go check it out. Subscribe if you don't mind. It helps. And if you are a TikTok user, a YouTube Shorts user, all of that stuff's going to be posted here real soon. So we're going to be streaming across all platforms, really to provide education. So with that said, Josh, let's get into why most people are here, and that is to answer some questions live. So Josh, one of the questions we get all the time, this is a really easy one. So we're just going to throw this one out there because it's easy. Nickel 6 deuce. Look at that. 619 562, baby. No, 562 562. I said 61. See,
you just confused.
I just made up things.
No San Diego.
I made up things. We got. I guess some 562 in the house. With that said, when does it make sense to recast, Josh? So maybe explain the difference between a recast and a refinance, and then you can talk about your little theory and when it makes sense.
Yeah, so a refinance replaces your current loan with a new loan at current interest rates. Most of you that are watching who have loans have a much better interest rate than what is available right now. So you would not want a new loan. So what we had from, say, 2019 through 2021, people who had a chunk of cash and wanted to put money in, not take cash out, but put money into their mortgage, would just come back, get a new loan, lower interest rate, bring some money in at closing, get a smaller loan at a better interest rate. That's not an option right now. What most lenders will allow you to do, but there is no guarantee. You can call them up, say, hey, I'd like to make a large principal payment. They're going to tell you what they define as large. It's probably not $5,000 or $6,000. It's probably more like $25,000 to $50,000. If you make a large principal reduction, they will recast your loan, which is a type of loan modification that allows you to take the remaining loan balance after your large principal reduction with your current interest rate and amortize it out over the remaining term of your loan. So bottom line, you make a big principal rate. So it's attractive. It's not guaranteed. The servicer doesn't have to go along with it. Most times they will because they want those loans on their books. The interesting thing is a lot of these lenders don't want a 3% loan on their books. It would be interesting to see if we get some of these rejected or servicers not cooperating with them in the current market. From the servicer's perspective, they do get paid for the servicing. They're not the owner of the mortgage, but there are rules that govern what can be done with pools of mortgages. They may get more strict with that with rates much higher than what most people's interest rates are at.
And if you currently have a 2.5%, 3.5% interest rate, unless you make a sizable down payment to recash your loan, you're talking very little difference in your mortgage payment, probably. Nothing, it's not going to be substantial. Every little bit helps, but.
Well, Jeb, if you have a 3% interest rate, those payments were about $5 per thousand. So if you put $25,000 into your loan, you're going to drop your payment by $125, $50,000, $250 if you have roughly a 3% interest rate. So the question that I always like to ask, would you rather have $50,000 available to you in a higher interest rate market where you can buy treasuries at 4%, or would you rather have $125, $250 lower monthly payment?
Good stuff. All right. Logical Thinker says Canada recently banned foreigners from purchasing their residential real estate. If there was a measure to ban non-U.S. citizens from buying U.S. residential real estate, would you vote for or against it, and why?
I don't know. We're on record here. Josh is on record. I don't like government intervention. Really, what we're seeing large foreign investment in is in high-end trophy properties. We have a lot of Chinese buyers that come over here and buy really nice homes. And do we have a problem? Do millionaires and billionaires not have enough homes to choose from? Not really. They're not coming over and buying large swaths of entry-level homes that we have a lack of. So to me, if we're going to have a policy intervention, I would like to see a policy intervention where we get rid of some of the tax advantages of ownership for institutional buyers of single family residences. There's a way to do it where it's not punitive, where it doesn't make it where, hey, you're just not allowed to invest in this, because there may be a time at some point in the future where you need additional investment in single family properties. You don't want to burn any market participant, but I would be much more in favor of that. It doesn't impact us a lot out here on the West Coast, but a lot of through the South and the Sun Belt where people want to move to, we literally have build to own communities. That's a wild concept to me, that an investor can say, I can build detached single family residences to rent out to people. It's interesting.
No, and I don't disagree. Government intervention creates additional problems in other ways. You want to see a change in the housing market, figure out a way to incentivize first-time home buyers, sellers to sell to first-time home buyers versus, maybe not having an investor be able to buy a property for X amount of days. Now, I don't even care. Even some of that stuff even gets a little too touchy for me. But I feel like that's where you need to go in order to help people out versus, again, a lot of the foreign buyers aren't the problem in the market here in the U.S. It is the institutions that are buying entire communities and that sort of thing that create problems. And I think that's where a better solution is. But more so what they need to do is figure out a way to get builders to build more homes to help out with the supply issue long term. That's the real.
Jeb, we also need our idiot politicians to give up on this fantasy that zoning laws are a bad thing. Like
Right.
when we build neighborhoods and we say we need X amount of parking, you need this much living space to square footage of a lot. There's a reason for that. It makes for comfortable living. So if we say, hey, let's get rid of the parking ordinances and build as much as you want on a lot, that's silly. I mean, especially for us in Orange County, we have more land, bigger lots, bigger streets. The fact that this is going on in places like Los Angeles County that are older cities where you have narrow streets, little lots, you're just like, oh my goodness, how many people do we want to cram in here? Like you have to say, like, I will always go back to this. And if you say this makes me heartless, maybe I am. No one has an expectation to live in Newport Coast or Beverly Hills. They look at that and
Bro,
they
you're
know
wrong.
homes.
I have one.
They know that homes are $5, $6, $7, $10 million. And they go, well, that's crazy. I can't really live there. We don't go, you know what they should do? They should subdivide those 4-acre lots into 50 or 100, 200 parcels and put affordable housing there. It sounds crazy when you say it, but we're saying, hey, here's other neighborhoods that have a home price that's,
Less
1/10
affluent.
of that.
Right.
And we're going to say those people have to build all of these additional units. Like there's two different pieces. Here's probably the best example. And we can get it out of my backyard and say that I don't have a dog in this hunt. On Sunday morning in my YouTube feed, a CBS News national news piece popped up about Jackson Hole, Wyoming. It blew my mind. I did not know how expensive homes are, how much it's out of area owners. They have a median income of like $350,000 and a median home price of like $3.5 million. Just insane. The person that they used as sort of the protagonist that they were interviewing through the process was a bartender in town, and she couldn't afford to own a home. And I go, well, okay, tell me more about her story. Well, 5 years ago, she moved to Jackson Hole from Massachusetts. I don't have a lot of sympathy for that person because the town doesn't need bartenders. They could survive with no bars, and you didn't have to move from Massachusetts to Jackson Hole. Now, if they had gone and interviewed a school teacher or a policeman, and that person grew up and lived their entire life in Jackson and just doesn't want to move out, that's the situation I'm looking at. And where I go, for us here in Southern California, we have a lot of that. People that are transplants that moved here and they're mad that they can't afford a home and don't want to move away, and they don't do a job that has to be here. There is a balance. Like there has to be workforce housing for people that need to be in communities that's affordable. So there's a balance, but it's not as simple as just making up crazy rules that you can build whatever you want. Like it's insane to me that in the last 10 years, we've had this policy change where we just say all of the things that we did to make sure that people could live comfortably in an area, we're going to throw that out the window. You can build whatever you want.
There's heartless Josh, guys.
And I didn't propose a solution. I don't have a solution.
Heartless Josh is what we're going to rename him. So don't worry about him, guys. We'll get a new co-host on here. Someone with not the scarecrow. Anyway, all right. So Kyle is asking a question. Do you guys think the rise of 2-income households over the last few decades has made housing more expensive? Easy answer is yes. I mean, when you have dual incomes, it makes housing in theory more affordable. You can afford more housing. You can push prices higher, and along with that, when you see lower rates and all of the things that we've talked about, that's what drives prices up. So yeah, I do believe a rise in incomes has added to unaffordable housing. Josh, anything you want to add on that one?
False premise, Jeb. False premise.
All right.
The bigger picture of the question and your answer is correct, but the question says the rise of 2-income households over the last few decades. It's been stable to decreasing over the last couple of decades. This largely was a phenomenon through the 70s, 80s, early 90s. So for the last 20, 25 years, we have not seen any increase. So it played a big role. People need to understand the two things that have led to home prices being as high as they are today relative to individual incomes. Compared to, say, the 60s and 70s, is the rise of dual income households. We had household incomes went up significantly, but largely because of 2 wage earners versus 1. Additionally, from 1982 forward, we had a 40-year bull market in interest rates. We went from mid to high teens all the way down to below 3% at one point. If you've been here for any period of time, you know that I believe that trend is still intact and we will have them go lower, but we'll never have a tailwind as big as going from 15% fixed rates to 3% rates. Even if we go down to 1%, it doesn't have as big of an impact. It's not as big of a boost to the market, even if it were to happen. Same thing with additional incomes in a household. We don't have another mom to go to work. We're not going to have 3 income households. Even if you saw, Jeb, the sister wives, they broke up. They all went home. They had their 6 income household, and the show is off the air, and they don't even live together.
Bro, who would want 6 wives?
That's a question for someone else to answer.
I mean, I love mine. 1 is fine. I'm good with 1. I don't need 6. 6 seems like a lot of work. All right, let's see. Some of these are tough to read. I sit here in silence, so I'm just going to read them on air and we'll figure out what's there. So any idea what's going on here? House listed for over 3 weeks with nothing. Then listing updated to submit highest and best offers by X date, and then listing removed, then active again, pending. You never know. Like, again, a lot of agents, what I see in agent remarks is they'll list a home, and in the agent remarks, they'll put something like all offers due by next Wednesday, right? Expecting that they're going to get multiple offers, and rightfully so over the last couple of years. Prior to the last 2 years, we never really put that in there. It was kind of like, hey, your offer's reviewed as it comes in. We're never really expecting 20 offers on a home. So I see more of that now. And then what happens is if that home doesn't get an offer on it, then they might change their strategy, lower the price, do something else, keep it on, whatever. But homes in this market are more likely to go in and out of escrow than the market a year and a half ago, in my opinion. And the reason for that is higher rates. A lot of buyers out there, unfortunately, don't pay as close attention to the market as you guys do, as the viewers watching the show. And so I could see people getting under contract and going, I had no idea rates went up by 0.25% or 0.375% from the last time I had this conversation and pre-approved, and their agent didn't tell them or whatever. And so people go under contract and end up backing out and changing. So a lot of things can happen with properties going in and out of escrow. The easiest way is to have your agent call the listing agent and figure out what's going on. I mean, I'm very transparent about this sort of thing. It's like, hey, buyer got cold feet, buyer didn't pay attention to rates or whatever. Just, hey, this is what's going on. But homes, here's the deal. Homes can sit on the market for a couple of weeks and still get asking price. So just because a home's been sitting on the market 10 days is nothing, guys. 20 days is nothing in the big scheme of things. I mean, what the problem is, everybody's used to a home going on the market in contract that weekend or the following week. It's that short-term mindset. Like, hey, they just remember what's been happening over the last 2 years. They don't remember the 20 years prior to that when, a home would sit on the market 60, 90, 100 days before it went under contract. I had homes in 08, 09 that were on the market for 300 days, 400 days. And talk about tough conversations and having to do some of this stuff. That's not normal either, but a home selling that quickly isn't normal either. And if you heard me say the short term, so next week's episode on the podcast is the long game. What does the long game mean in real estate? Why do we talk about a longer term mindset? What does that mean? How can that benefit you? So if that's of interest at all, check out next week's episode here on YouTube and or Spotify, Apple podcast platform. It will be out there. So,
and Jeb, Kim has a bone to pick with you. She says, "Who would want 6 husbands?"
Ooh, even better. Not me.
That sounds worse.
I'll be the first to tell you,
worse.
I wouldn't want 6 husbands. So you can jump in line behind me. I'm number 1 in line for that one. Let's see. Elay says, when making an offer below list price, say 5 to 10%, nothing crazy. Seems crazy. Should the buyer state a reason for the offer or just make the offer and wait for the seller to ask questions? 5 to 10% in this market, depending on where that home is priced, depending on your market, seems crazy. And I'll use an example. Say a home's listed for $1 million. You offer $900,000. In my market, that would be crazy. Just because, it's, if it was priced right now, if it was overpriced, it's a different thing. So if that's the case and it's overpriced, then maybe you have your agent kind of, warm up the realtor to what's going on before the offer submitted. Hey, listen, we were looking at comps. We don't think, the price is right because of these things. This is kind of where we're seeing the price, and have that conversation versus just blindly submitting an offer 10% under the asking price. 5%, a little bit more reasonable, again, depending on where it's priced. But I'd like for agents to have conversations when, doing that sort of reduction in price or offer price, just because I think it's a softer, opening to the email. Like if I get if I'm listing a property for $1 million and I think it's priced right, and you send me an offer for 900 without any context, I'm thinking, are you have any idea what's going on in the market, versus somebody calling me and having that conversation. So have your agent have the conversation with the seller.
I don't know that there's ever a time, Jeb, when communication is bad. I guess if your agent was a bad communicator, it would be likely to say something that would upset the other side or divulge something you don't want. But other than that, if you have a good communicator, any form of communication, even if it's just to strike up a conversation, a friendship, and a familiarity, so they go, oh, hey, there's that offer from Jeb, versus, hey, here's random offer from some dude I don't know in my inbox.
Agreed. A couple of questions that are, that we get all the time. Kind of try to just see if there's anything here, guys, that we don't. Here's a good one. Kim says, I think you guys have covered this before, but how many times can you lock a rate? Is it throughout the process or until the loan closes? So what's the answer, Josh?
When it's locked, it's locked. You are committing to close at that interest rate, and the lender is committing to deliver you that interest rate, assuming that you close that loan program at that date. So you can get an extension. There are limits to the extensions, whether it's a total number of days, total number of extensions that you ask for. And there's generally a cost for that extension, because there is a true hedging cost to the lender. It is not free to the lender. They don't have access to a pile of money at a specific rate. So they are actually committing into the secondary market to deliver X number of each product, and they have to hedge that in case rates go up. So you don't get to lock it multiple times throughout the process. A lot of times, if rates move even the littlest bit, I'll get a borrower who locked 3 days ago, say, I just saw the news Thursday, the Freddie Mac primary mortgage market survey came out and rates dropped an eighth. What do I need to do to get that? You can't get that. Just like the lender can't come back to you and go, hey, they popped up 0.25% this week, I want to give that to you. So realize there's a give and a take. For most people, the right decision is to lock, because they don't have the risk tolerance to be comfortable with a higher interest rate.
Yeah, good stuff. Let's see. There was another one. Well, let's just go to this one. John. Yeah, we're just in the next 5 years. Do you think prices, Josh, will be higher or lower than they are today?
I think they will be higher. And let's look at why. Actually, this was a sort of a different response, but in a response in the comment section on the channel today, I said there's only 3 things that can improve affordability. And actually, the person accused us of not caring about the affordability issue. I do. I talk to people regularly. We use an example on the recording today of next week's podcast, Jeb, someone who makes 6 figures, husband and wife, and they had a pretty reasonable request of what they wanted to buy. And although we could get them qualified for it, they agreed that that's not affordable. That's not reasonable. We can't do that. So big picture, what are the 3 things that can improve affordability, which we need improved affordability to see a significant increase in home prices? Incomes can go up, and I do believe they will. Not at 5, 6, 7% a year. That would make a huge change, but 3% a year over 5 years is close to a 20% cumulative increase in wages. Interest rates can come down. I think in 5 years, we'll have rates at or below 5%. So those 2 things go a long ways towards putting a bid into a market that has limited supply. So I think affordability puts the ceiling on it where it can't be a lot higher, but I think that the demand and the improvement in wages and interest rates, no matter how minor they are, is going to make affordability better than it is today, and will keep prices slightly higher than where they are.
All right. Good. I saw another question here, Josh, that I wanted to click on. This one's easy. When you and your sister obtained your dad's property, did you sell it? And if you did, what was your cost basis? And if you did, was your cost basis then the new appraised value, or when your original family member bought it? And explain why.
That is the beauty of inheriting real estate. You get a stepped up basis to the value of the day that the person passes and you inherit the property. So we had to do, I believe they call it a forensic appraisal, where they go, we did it 5-6 months later. We said, I need an appraisal as of May 20th, 2020. And they went back out and only used comps that had closed in the 90 days before that and gave us a value. As the new owner, you actually want that appraised value as high as possible, because that sets your new basis. So we didn't sell, but I have a report, an appraisal report sitting in my Google Drive that shows this is what our basis is. We use that for our depreciation every year on our taxes. That tells us what the structure value is that we can depreciate over the next 27 and a half years, because we kept it as a rental. An interesting side note, Jeb got to hear this. I got a phone call today, unsolicited, from someone wanting to know if I wanted to sell my house at that address. So if you're interested, the answer is no.
Aguas. That's why
It could
they're
be
asking.
Aguas. He may have called. We still own it, and no, we do not want to sell it. I will die with that home, and my family members will also have it, and they'll have to get an appraisal for their stepped up basis.
So answer me this, Josh. If it's in a trust, you get the step up basis. If it goes to probate, do you still get the stepped up basis?
If you are the rightful heir to the property, yes.
You do. Okay. I thought one of the benefits of leaving it in a trust outside of it going to probate was the stepped up basis. I was unsure if you did not leave it in there, if you still get the stepped up. So
we might, Jeb, want to cover that for a topic of the podcast going forward, because there's
trust,
some interesting pieces, not just the trust, but an interesting piece as joint tenants. What happens if a joint tenant passes? You get at least a partial stepped up basis on that. So it'd be awesome to have a true tax expert that could walk us through that.
No, that stuff's good. And here's what I'll say. If you own a piece of real estate, get some sort of trust, some sort of will, some sort of, what happens after you, if something does happen to you, so that things are going in the right direction and your family members don't have to deal with that after, something, if something does happen to you. I see it all the time. It's a big problem. It's something you can do to make things a lot easier for those down the road. So, Josh, I'm talking to you. All right.
Jeb did his own. I am hiring a professional.
I did one in the past with a professional. The second one I did on my own. But yeah, anyway, yes. So do it. Regardless of how you do it, do it. Let's see, Josh, I saw this question and wanted to click on it because I have a bone to pick here. Which organization's stewardship will lead to the better outcome in 3 years? The NCAA with college football or the Fed with the housing market? And I don't really care what the answer is. I just have a problem with the whole college football thing, in the fact that I'm an ACC guy, right? So Atlantic Coast Conference. I come to read Saturday morning, I think, that we've now invited or added Cal, Stanford, and somebody else into the Atlantic Coast Conference. How does that make any sense whatsoever? And outside of college football, say you're a track star or you're a swimmer. You're going to travel 3,000 miles across country to, like, how does any of this stuff make sense on a financial piece, for one? But a big picture, I'm blown away. I don't know.
The good news is, Jeb, for like wrestling and track, you don't have to worry about them because they have like multiple team meets. So they travel much less. But for like volleyball or soccer or these sports that are non-revenue sports, Olympic sports, this is insanity. What I said when they came up with this idea of NIL and letting the kids get paid, I said, this is Pandora's box. The majority of the kids do not deserve. They don't generate revenue. The name on the front of the jersey. And I'm a college athlete. I played college basketball, walked away with no student loans because of that. And it was an awesome experience. Now, the difference is, say if I was better and I had played basketball at Duke, even if I was the 12th guy on the bench.
That's the word. Why would you play
that? That person. Okay. You want me to go to North Carolina? At North Carolina.
You played at Tar Heels. Now you're a respectable team.
So every year, Jeb, North Carolina and Duke both bring in 4 to 5 4- and 5-star recruits. Mm-hmm. Now, when was the last one for either one of those teams, a guy that moved the needle and brought in eyeballs? It was probably Zion. So there is 1 to 3 basketball players and 1 to 3 football players every year that people will pay to see. Other than that, we're there to watch the name on the front of the jersey. And when I said the downside to this of paying them, whether you think they deserve it or not, and it's a valid debate, you can have that. But as soon as you do that, it's now a professional sport. And all of this realignment have said this is a minor league professional sport. So we should give up on all these leagues, and all of the non-revenue sports should be able to stay in their long-term conferences, do what they want to do. And the basketball and football, the only two revenue sports, make a big 50, 60 team super conference and put them in divisions to fix the travel issue, and have a playoff every year and sell off the TV rights and make as much money as you want or can. They don't need to ruin all sports because they want to maximize revenue out of football and basketball.
Agreed. And we could have a whole podcast on that alone.
Let's do it.
But for tonight, we're gonna digress and move along. So Jose said, long time no see. Congrats on 90,000. So just short of 90,000 subs on the channel. Thanks to you guys, right? You guys are the support. You guys show up every week. You guys are the ones that watch my videos and help the algorithm. And I'm thankful for that, guys. So I appreciate you. Without that, I wouldn't be here. So
Jeb, I'm going to do a favor for you. Last week, we needed some subs to get us over 2,000 for the educated home buyer. I asked for it and we got it. You need 10,000 to get your silver plaque. I need 10, you guys to jump out, and Jeb needs 10,000 subs in the next 7 days.
Wow, that would be amazing in 7 days. That would be more growth than I've seen ever. So that would be crazy. All right. But no, thank you guys. That's where I was going with that. Let's see. So Kyle, you asked a question that we've already answered. So actually, yes, we more or less addressed that. So let's see. Josh, let's go to somebody that hasn't had one answered. SNN Media. So this is something people say all the time, right? The government's fixing the data. The data from the government isn't correct. You could say it's lagging. A lot of it is lagging. But how accurate do you feel like the data is from the government on, say, jobs numbers, on ISM, on these different reports, surveys, if you will?
It's funny that you ask this, because I was thinking about it on the way in. And I honestly, I think it's both. I'm not a big conspiracy theorist, but we get these questions from you guys all the time. So it makes me think, am I naive to think that they're not manipulating it? If you look at CPI, there's been 25 revisions over the last 30 or 40 years. So if we look back and say, hey, in 1982, CPI said this, and today it says this, they're very, very different measures. And I think it would be naive to think that the government hasn't kind of pushed it in directions that they want it to go. At the same time, those are important measures that are used for policy decisions, and big picture, I don't think anyone wants to make bad policy decisions. So again, I'm not a conspiracy theorist. I don't think they're massively manipulating it. I think they're finessing it to make it tell the story that they want.
So with that, Josh, I'm going to ask a separate question and say, next year's an election year. Next year. Yes. Next year's an election year. Is there a possibility that current presidency uses that as an opportunity to stimulate, I wouldn't say housing, but bring down lower rates in how they can control it, whether they're pushing or doing things that they can do, we'll say finessing, other people to bring down rates? Is that something that you feel like is realistic? Does that happen in election years, or is that a conspiracy as well?
I think that the party in power, 4 years ago it was Trump, now it's Biden. Yep. I think they will do everything they can to make things look as positive as possible. People vote with their pocketbooks. They want a strong economy. So the Biden administration is going to do everything they can to keep the economy going as well as it can. The funny thing is, we're sitting here, inflation is moderated. A year ago, 2 years ago, everyone was on fire, like inflation's the worst thing ever. Now it's receding. It's not as big of an issue for people, but we've got low unemployment, 3.8, even with increased labor force participation. And you ask people, you see the consumer surveys, and the consumer is not going, hey, this is an awesome economy, despite the fact that there are things that say that it should be. It's sort of the question we get here every week. Are we now a renter nation? What happened to upward mobility? People feel like it's harder and harder to get more. And again, I'm the heartless one, but I feel for everyone who is younger, because you didn't do anything wrong other than being born later. You didn't have time to accumulate assets, and the policy decisions that both administrations, Trump and Biden's, made through COVID greatly inflated the cost of assets for those, which was a benefit for those that owned them and is a big negative for those that did not. It's sort of Pandora's box. The genie's out of the bottle. How do you put it back? How do you fix it? How do you change it? I don't have the answer to that.
Good stuff. Yes. Here's a question, Josh, that's going to be difficult to answer, but I think it's a good conversation. Marcus says, I found a house listed for extremely high rent that's been vacant for several months, but the landlord won't reduce the price. Thoughts on why he wants? So, Josh, somebody that owns rental property, is somebody that manages rental property. Why would a landlord rather a property sit vacant than reduce price? And we don't know the numbers here and what have you, but then rent it to somebody for a lesser amount.
I think it's ignorance for the most part. Let's go back and go to my dad's place.
Yep.
So my sister and I had a vacancy. Guy had been there for 2.5 years, was a great tenant, took good care of the place, and had a Zelle every month, first of the month with the payment. So we were a little bummed about that, but we looked at, hey, rents have gone up. So we were able to increase the rents about 10%, which is about in line with what the market had done. 2.5 years, 3% gets you somewhere in the ballpark of 10%. We were just shy of a 10% increase. But going through those numbers, I worked through it with him and said, hey, is there anything we can do to make this work for you to stay? And he had situations in life that he couldn't. But the reason why that was beneficial for me is after 2.5 years of him being in the property, the carpet hadn't been replaced for 2.5 years before that. So we had 5-year-old carpet. Between carpet, paint touch-ups, some repairs, we spent about $3,600 and we lost 15 days of rent. So about a $5,000 expense. So at an additional increase in the monthly rent of $300, it's 20 months before I break even. And I think there are a lot of landlords that don't stop and think about this. Like, do I want the highest market rent? I think every property owner does. But what I most importantly want, I want a lot of applicants in a short period of time willing to pay a fair market rent that I can pick the best tenant who's willing to move in soon. And I don't think a lot of owners think that way. They just think I want to maximize my rent, and they don't take the time to pencil out what that means. And I also think, there are not all renters, but there are a percentage of renters that say, hey, if top of market is 2,800 and I'm paying you 2,950. Well, I'm going to take it out of your property. I'm not going to do this. I'm not going to do that. I'm going to beat this up. I earned it. I paid for it. So I want my tenants to want to stay as long as possible, to feel like they're getting a fair value, and to take as good a care of the property as possible. So it's like a balance. I don't want to put the lowest rent on there and leave money on the table, but I don't want to put the highest on there and have the tenant feeling bad. So when I hear something like this, to me, it's someone that just doesn't understand the true cost of a vacancy. What are your thoughts?
No, I'm with you 100%. I mean, if you have somebody that's looking for, let's just make the numbers easy, $2,500 a month in rent, and they can't find anybody, but you got somebody willing to pay you $2,300 a month in rent, by missing 1 month of vacancy in that property, you've lost, it takes you a year to make that up in what you've just done. So I think it's better to lower the rent to an amount that, again, it's got to make sense. You got to find the right applicant, good credit. I think finding the right applicant is way more important than getting max top dollar for a property. There's not a time where that would not be the case, in my opinion. So if it requires taking a little bit less money, but finding a really, really good tenant, I think that's always the right answer. So depending on what these people are trying to do or what they're trying to do, they might, maybe they're looking for tax write-off and they don't care. They've got something else going on. You never know people's situations. I've seen people do crazy things for way less money than this situation. And I don't
Well,
even know
Jeb,
what we're talking about.
look at this comment in relation to that question. He probably owns the property free and clear. Very good chance owns it free and clear, so they don't feel the pain every month of making a payment, and they're not smart enough to sit there and do the math of how long. Too short. Get a calculator, baby. Do the math. But that one went over your head, Jeb. North Carolina, you don't know about Too Short. But
Oh, I know about Too Short.
They don't do the math, and so they go, oh, it's not really costing me any money having to sit there because I don't owe anything. It's an opportunity cost. It is lost money. You do not have that money coming in. And Jeb, we've got another. This is more of a comment here, but I want to react to this one. Gina says, young has a chance to make their money. You need to feel sorry for people that are 60 and older that are going to be set only with Social Security and not a whole lot extra from the market. I don't know. I don't want to argue with someone. If someone's got to that point and haven't set themselves up, yeah, I feel bad for them. But a 60-year-old grew up 1963. So 1963 to 1990, if you put your nose to the grindstone, worked hard, did the right things, you should be set at this point. We have the hurdle for entry level to many assets right now is really, really high. I think it's short-sighted to look at the younger generation and say, hey, we've set everything up perfectly for you. They have a higher bar to jump than I did, and I had a higher bar to jump than the generation before me, but it's almost like a steepening curve because of the policy decisions our government has made.
All right. I have a question saying, do sellers prefer buyers who use VA, FHA, or conventional? So I would say, traditionally speaking, in my experience, sellers prefer conventional loans because that's what they know. There is the stigma around, VA being zero down. There's stigma around FHA being, it's only for low credit buyers. So it's the agent's responsibility to provide context and to provide details on why those loans aren't bad. Unfortunately, a lot of agents also have the same misconceptions that sellers have. So with that, I've had veterans before that I have clients that would love a veteran to buy their house because they understand how hard it is, how difficult it is. And so they are looking or leaning more towards VA. I can't say much about FHA in that regard, but there shouldn't be a preference as long as everybody's qualified, because at the end of the day, the money is the money. But typically conventional, gets, labeled as the better loan because people are putting traditionally a little bit more money down, so on and so forth. So, but don't get caught up in that. If you're using FHA, then make the best offer you can with your loan. Let your agent do what they can do, and that's all you can do. Don't get beat up and don't beat yourself up because you're not doing what you think everybody wants to see.
Jeb, on that note, what I will say as a lender who I talk to the client and we're going to figure out the optimal financing for you, oftentimes when it's an out of area agent, someone buying up in Sacramento, and I don't know the agent, it's truly the mindset of that agent. I have several, that we've come across to say, cool, if they qualify for FHA, we will make it happen. We will stress to the seller and their agent why and how it doesn't impact them and it benefits the buyer. And I've had others that it's generally not the agent that tells us, but the borrower will call back and say, well, we talked to this agent and they said, we can't get an FHA offer accepted. And I go, cool, fire the agent, because it's not true ever in any market. I mean, Jeb, we had those FHA buyers here in Southern California that I think you wrote 33 offers for them in the middle of 2020 or early 2021. It's just mindset. You go until it happens. You don't do something suboptimal for the buyer or borrower just because it makes it slightly easier to get an offer accepted.
And with that, I'll say this Friday's video is a video on a property that I just sold. We received 26 offers on it. I think at the time I did the video, there were 22 or 23 offers because I did it right after I got the offers on the property. I didn't post it immediately because I was waiting for to make sure it closed or whatever, but we ended up with 26 total. With that, the two best offers came in. Our list price was $810. We had one at $900,000 that was conventional, and one at $900,000 that was FHA. I was rooting for either of them. I didn't care if the FHA. If my client ended up going with the conventional because they waived basically everything. And it ended up just being a better loan because of that. But had that offer not been there, my suggestion to my clients would have been to take the FHA offer. Simple as that. And we had cash offers. We had people putting 20, 30% down, not as high of a price. So my clients were looking for the best price. And the way they structured that FHA deal, we were willing to accept it if I had the choice. So it just shows you agents need to understand that sort of thing as well. So with that, Josh, we're going to add anything? I mean, we're here at...
What I was going to say, Jeb, is at the end of the day, the agent's responsibility is to facilitate a successful closing that maximizes the profit for the seller. And if you're focused on the type of financing the borrower that's getting, there's a good chance you're leaving money on the table.
There you go, guys. It's been an hour already. Would like to ask a favor. There's 167 of you watching on 2 different channels here. We got 57 likes. So there's 110 of you in theory that could hit the like button and boost those numbers immediately. Would you do that? That would be awesome. If you haven't already, subscribe to the channel. If you like the content that you hear on Jeb Smith's channel, my channel, go over to the Educated Home Buyer. That is an additional resource, if you will, if you're somebody looking to buy a home in this market. More detail in some regard on different subjects to take you down a different path and really help you become the educated home buyer. If you're on the Educated Home Buyer and you haven't done so, go over to Jeb Smith. Follow us on Instagram. We're now on Instagram at the Educated Home Buyer, I believe is the channel, the handle rather. So go check that out. If you need a lender, West Coast, refinance, purchase, just to have a conversation, see if you qualify, you can reach out to Josh directly. There is a banner scrolling at the bottom there. If you need a lender anywhere else in the country, maybe get a second quote, see where you stand. Again, have a conversation and see if it's possible. That link will get you there as well. It also gets you in touch with a real estate agent. With that said, Josh, final words.
Final words. I was going to post a link, but my system isn't pulling it up. Jortholomew Observer asks about will lower cost of living areas become more attractive? On the Educated Home Buyer 2 weeks ago, 10 days ago, we actually did an entire episode on this. It's an important one, especially for those of you who feel like you've been priced out of the market. There's not an easy answer on that. So really just in closing, it's a difficult market all the way around for everyone. Again, people think, hey, home prices are high. That's great for realtors. That's great for lenders. Yeah. It is not. Transaction volume is 50% of what it was 2 years ago. It is not fun talking to people and telling them you can't qualify, or you can qualify. The payment is $1,000 more a month than you are comfortable paying. That stuff is not fun. So it's not a good market for the pros. It's not a good market for the buyers. I guess technically, if you were a seller who was going to ring the cash register and take the money and ride off into the sunset, it might be a good market for that person. But most sellers are buyers also, so they get hit on the opposite end of it. So just control your mindset, do what you can to control what you can, maximize your career, your wages and income, your credit, your savings, your investment, and the time will come. Do the right things and good things will happen for you, even if it doesn't happen today. But keeping that mindset, one of my mentors said, I repeat this mantra every day. It says, good things are always happening to me, even if at the time it doesn't seem like it. And it's just, you're telling yourself that good things are happening and you will start to see those things. And the flip side, these Debbie Downer people, I feel bad for them. That is their mindset. They see the negative, they see the bad and everything, and they think everything is hopeless. And both of those things become self-fulfilling prophecies. So keep your head up, do the best you can, and things will work out for you over the long haul.
Little did you know, we just turned into a personal growth seminar within a couple of minutes. But I agree with Josh on everything he said. Our premise is buy right, borrow smart, build wealth. The channel's all about that. If you're looking to be that person, continue to watch, continue to share it, continue to follow your plan. And with that, we'll be celebrating you soon enough. So till next time, guys, adios.